Hey everyone, welcome back to Corporate Decoder, the place where we demystify confusing corporate jargon. And today we are diving deep into Flaherty and Crumrine Preferred and Income Securities Fund, Incorporated's latest report. Let's just say this filing has more twists and turns than a daytime soap opera. And we're here to decode exactly what it all means for investors. So what is the big story with FFC or Flaherty and Crumrine Preferred and Income Securities Fund, Incorporated as they are formally known? This is a report for their fiscal year ending the 30th of November 2025. While markets saw some ups and downs early in the year, things settled down in the second half thanks to strong company earnings and supportive Federal Reserve policies. The fund saw a total return on its net asset value, NAV, of 9.4% for the full year. But here is where it gets really interesting. The market price of their shares actually jumped 13.0%. That is a solid difference, suggesting investors were perhaps more optimistic about the fund's future than its underlying assets might have initially indicated. Let's quickly look at some of the performance numbers. For the full fiscal year, the fund itself delivered a 9.4% return on its net asset value. Now that is good, but the real kicker is the share price performance, which was a much higher 13.0%. This spread between NAV and market price is something we'll touch on later, because it's a key indicator for closed-end funds. Looking at how they break down the return, the actual portfolio of securities contributed 8.2% over the year, but here is where leverage and their at-the-market program really kicked in, adding another 2.1%. Expenses, thankfully, only took away 0.9%. So it is clear that the fund's strategy and its use of leverage were significant drivers of that outsized market price return. Scroll net asset value BRI market price. Now let's talk about the market price versus the net asset value, or NAV. At the end of November 2025, the NAV per S-Hair was $17.63, while the market price, what you could actually buy or sell it for on the stock exchange, was $16.67. That means the shares were trading at a discount of about 5.45%. This is pretty common for closed-end funds, but it is also a point of interest. Management mentions they might consider actions to reduce this discount, like share buybacks. They also highlighted that the fund's stock price often doesn't track NAV closely, which is a crucial point for investors to understand. Now let's talk about leverage. Funds like this often borrow money to boost returns, and FFC is no different. They have a significant loan of $502 million. This leverage is a double-edged sword. It can amplify gains, but it also magnifies losses. The report shows that for every $1,000 of debt, the fund had $2,692 in assets to cover it at the end of 2025, which is a healthy ratio. But if the market turns south, that cushion can shrink fast. This leverage cost them about 4.95% on average over the year, which is a pretty hefty expense that needs to be overcome by investment returns just to break even on the borrowing costs. This table really illustrates the power and peril of leverage. If the fund's investments performed poorly, losing 10%, the shareholders' return would be a dismal negative 18.84%. That is a double whammy. But on the flip side, if investments did well, gaining 10%, shareholders could see a fantastic 12.98% return thanks to that borrowed money working for them. It is a high-stakes game they're playing. Diving into the portfolio itself, it is heavily concentrated in what they call preferred stock and hybrid preferred securities, making up nearly 76% of their managed assets. A massive chunk of this, or 32.2%, is in the banking industry. You'll see big names like Bank of America, Citigroup, and JP Chase. They also have significant holdings in insurance and utilities. This concentration means that if the financial sector or utilities sector take a hit, FFC will feel it disproportionately. Another interesting area they invest in is contingent capital securities, or COCOs, which make up over 21% of their assets. These are particularly risky instruments, often issued by banks, that can be forced to convert to equity or even get written down if the bank's financial health deteriorates. It is like investing in a security that can spontaneously become much riskier. You see names like Banco Bilbao, Vizcaya, Argentaria, and Banco Santander here. Looking at the credit quality, almost half of their investments, 48.5%, are rated BBB, and another 32.9% are BB. This means a significant portion of their portfolio is considered below investment grade, meaning higher risk for potentially higher reward. About 14.7% is actually unrated, which adds another layer of uncertainty. In terms of income, the fund generated $89.3 million in total investment income, mostly from interest from their debt holdings. Expenses were about $34 million, with a large chunk, over $26 million, going to interest expenses on their borrowings. That is a direct consequence of their leverage strategy. Now, this is an interesting number. The fund has a total distributable earnings loss of negative $123 million. This indicates that on paper, their accumulated earnings are negative. However, they also show a large paid in capital in excess of par value of over $972 million. This means that while their operational earnings are in the red, they've raised a lot of capital from selling shares, which is why they still have substantial net assets. It is a bit of a mixed picture on the accounting front. A key selling point for this fund is its tax advantages. For 2025, they highlight that almost 99.3% of distributions qualified as qualified dividend income, or QDI, for individual investors. This means shareholders could pay much lower tax rates on this income compared to regular bond interest. They even state that for someone in the 32% tax bracket, this income is taxed at a blended rate of just 15.1% instead of 32%. That is a huge benefit. For corporations, 40% of distributions were eligible for the dividends received deduction. However, they also wisely caution that these tax treatments can vary year to year. This filing is also very upfront about the risks. They talk about market events risk, mentioning things like geopolitical developments, natural disasters, and public health epidemics, all of which can cause market volatility. Then there is preferred contingent capital and other subordinated securities risk, which basically says these investments are riskier than traditional bonds. They also specifically call out contingent capital securities risk and concentration risk, reminding investors that their heavy focus on financials and these complex securities carries significant potential for losses. The report also detailed leverage risk, emphasizing that leverage magnifies both gains and losses. So, what is the bottom line on FFC Preferred and Income Securities Fund Incorporated? On the positive side, their strategy of focusing on preferred and income securities, along with the use of leverage, led to strong market price returns for shareholders in 2025, significantly outperforming NAV growth. The tax advantages are also a major draw for investors. However, the fund does carry substantial risk. The heavy concentration in the financial and utilities sectors, combined with significant holdings in high yield and contingent capital securities, means that a downturn in these specific areas could hit the fund hard. Management itself is very clear about these risks, which is commendable. The discount to NAV is also something to watch, as it can erode returns if it widens. In conclusion, FFC appears to be a fund that, when market conditions are favourable, can deliver very attractive returns, especially to shareholders who can benefit from the tax advantages. But it is not for the faint of heart. If you are looking for stability, this isn't it. If you are comfortable with higher risk for potentially higher reward, and can navigate the complexities of preferred securities and leverage, then it might be worth a closer look, but always remember to do your own homework. Alright, that is our deep dive into Flaherty Crumrine Preferred and Income Securities Fund Incorporated's latest filing. What is your take on these financial results and the risks involved? Let us know in the comments below. If you found this breakdown helpful, give this video a like and subscribe for more in-depth corporate analyses. And be sure to join our Discord community. The link is in the description where we discuss these filings and much more. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.